Today's panel is going to talk a little bit about, in fact, quite a bit about, what's happening in the venture capital industry, certainly throughout Europe, which is where we're all focused, Europe and the UK, but also from a global perspective. And what are some of those trends? Not only venture capital in the space industry, but as a whole, because the industry itself obviously is very impacted by a number of other factors, right? Public offerings, liquidity events, things of that nature. So we've got a great group here today. I'm going to start off at the other end with Amal. If you could do just a quick introduction about yourself and what you do, and then Jody, and then I'll go myself.
Yeah, hello. Good morning. So I'm from Tag Bankers Group. The company represented here is 2X Tag World Exchange, which is a fully owned subsidiary that where we list all the offers that we have and all the things that we do. So we help companies at all stages, from an idea to doing a SPAC. So basically it's all in between. We help them get access to capital, and that's basically us in a nutshell what we do.
Thank you. So, hello, good morning. I'm Jody Barton. I run a company called Citicourt & Co. So we're a small investment bank based in central London. We do corporate finance, so we buy and sell companies on behalf of our clients and do institutional fundraising rounds, restructurings, that sort of thing. So we've been involved in most of the space transactions in the UK over the past few years. I've got an amazing team. Stuart Martin is our head of space. Stuart was the founder of Satellite Applications Catapult 10 years ago. So he's overseen about 1.4 billion going into about 700 space companies in the UK over the past 10 years. And we've got Sir Martin Sweeting, who's the founder of Surrey Satellites, SSTL, as our ambassador. He designed and built and launched the first ever small satellite in the world in the 1980s. So we got an amazing space team. We don't only focus on space and aerospace, but that's about 50% of our business.
You hear me okay? As I mentioned, my name is Richard Kivel. I'm the managing director of Graybella Capital, which is a London-based pan-European fund. We originally launched about 3-4 years ago in the area of deep technology and also looking at health tech. And the fund is very much focused around growth stage capital. So not pre-seed, pre-A type of companies, but companies that are at the point where they're either commercializing technology or they already have revenue and they're bringing that revenue internationally. Like Jody, we're also launching a new fund called Gray Space Capital, which will be dedicated specifically to the space industry as well as energy and sustainability sector. But between energy and space, it's where we've seen the greatest amount of growth and also the most activity related to deal flow throughout Europe. I want to start off just by pointing out a data point that I think everybody here may realize. Between 2023 and 2024, for the first time in a number of years, we saw a decline in the number of venture capital deals, as well as the total amount of dollars, euros, pounds invested in venture capital. And that was internationally. That was not just Europe or the US or the UK. It wasn't a dramatic change, but across the board, there was a decrease. Oddly enough, in Europe, France, and the UK dropped in the hundreds of millions, not billions. The Netherlands, ironically, actually increased between 2023 and 2024, which is a good sign for the Netherlands. In fact, we're in the middle of doing a deal in the Netherlands right now. But between 2023 and 2024, I think we all know there was significant geopolitical issues, wars, issues associated with a lot of countries, including the US and others in Europe, having elections. But there seems to be some stability there now. And I would love to hear from Jody and certainly from Amal, how are you seeing the shift between 24 as we go into 2025? What are you seeing from a venture capital perspective?
Yeah, I'll take that. So, like I said, we do not only space and aerospace fundraising, but we do sort of across the piece. The end of last year was pretty dire, to be honest, Richard. I'm sure you'll agree. It didn't end very well. But then we started January with an absolute bang, and I've got a list of about 25 space fundraisings that have happened in January already in the US and Europe. So no, it's absolutely flat out. So what we're seeing basically is, with interest rates where they're at and threatening to increase, I think the equity markets are coming back into themselves a little bit. We've got Voyager Technologies, who has, I think confidentially, indicated they're going to IPO in America. And that's a really big deal. So I think that once we get IPOs going again, the space sector will really start to recover properly. The venture capital space for private companies is still sluggish, to be honest. There's only a handful of space venture capital funds in the world, specialized ones. So, and in our corporate finance business, we talk to hundreds of investors every week, and deep tech investors and things like that, trying to persuade them to come into really good space technology businesses. And they often tell us they'll come in, they'll write a check, but they don't want to lead the round. Because they don't understand the sector enough. They don't think they understand the sector enough, where you and I know it's actually not that complicated, the sector. So what we're doing at Citicorp is we're raising our first VC fund. We're raising 100 million, and we're going to lead syndicated rounds in the space sector so that we can bring a lot of these deep tech and generalist investors along with us into really good impact-driven space technology companies. So I think once we do that, I think over the next 18 months, we'll see more and more space funds around the world being launched, and that's really what the sector needs. I mean, we work very closely with the UK government in respect to helping the sector in general survive and get through this next phase of growth and expansion capital. So there's, as you know, most of the companies in the UK and Europe have been funded by governments, ESA, UK Space Association, incubators, and that sort of thing. And now's the time for private venture capital to step up to the plate and fund these companies properly and support them. So we're working really, really hard to try to make that happen and create what we think will be a financial services industry, in particular in London, in the space sector in the next 18 months.
That's great. Amal, anything to add to that?
Well, as all of you guys said, last year was horrendous. That's and mainly for us because our core activities in the US, actually, even though we are London-based, but it was very bad because of the upcoming elections. But then, funnily enough, when it was the election was over, things changed drastically, actually, because apparently, for business, it's very good what happened. For living, and normally, I don't know, but for business, yes, it is. Look at the markets; all the markets shoot back up. So, and us being sector agnostic, we don't only do space; we do plenty of other things too. We are finding out that now there is a big kick coming back, and things are started moving again. And that's in a nutshell us. I mean, it's we have big hopes for 2025 actually, and we have just launched a new hydrogen fund, so to speak, with specialized companies doing a home power generation unit using hydrogen. So that's which of course got some application for space and satellites and launches and everything. So that's us.
I think it's also important. It's also important to point out that stage of development really matters. The later stage deals are getting a majority of the funding. And that's not just dollars. Obviously, those are larger rounds, but it's actually number of rounds. It was predicted last year, I think it was a total of around 4,000 companies were funded that were seeking under 15 million. So call them pre-seed, seed, Series A, whatever the new letter is. It's almost geographic, depending. A Series A in New York or Silicon Valley is a lot different than a Series A in Estonia. But just taking those numbers, looking at $15 million, euros, or pounds, companies raising less than that, there was about 4,000 of them last year, and that's the lowest number since 2015. So what we're hoping for this year is an increase. And that really goes, I think, very well to the point that Jody made around finding a lead. One of the great advantages in Europe versus many other areas is that there is significant capital coming from the government. Government funds, not only European-wide funds, EIC being a great one. We're doing the project in the Netherlands actually is a 15 million euro financing. EIC is doing 6.5 million of it, but they won't lead. And family offices very often won't lead either. So it's really important as an entrepreneur, if you're out there raising capital, to get out and think about who are we going to raise capital from and what kind of lead is going to attract the bigger dollars. Because EIC can't lead, won't lead, and they want to approve the lead you do choose. So thinking about who can lead this round is very, very critical. So you've got to kind of play both sides of it. You've got to be out chasing the family office money and the governmental money, but also searching for a mid-size or larger venture fund that's willing to take that risk on that financing. And that will hopefully have a big impact on what we're seeing in the early stage.
Yeah, no, I totally agree with that. And I think if you're an early stage business, getting that strategic investor secured is absolutely essential, so that you can it's bragging rights more than anything. Even if they give you just a token amount, you can say you've got this strategic investor in. So work really hard to get someone to give you a few $100,000 euros in someone known in the space industry or someone known in the deep tech industry, or maybe even I think a lot of times companies don't think about going to corporates for investment. So all the big primes have something they call CVC divisions, corporate venture capital, and they will also they all have different criteria, but 90% of their investment goes into companies that are commercially strategic. So if you're doing a deal with Airbus, for example, or Lockheed Martin, and they're going to take your payload or some sort of commercial deal with them, ask them if you can be put in touch with their CVC division, and see if you can get their venture capital division to also invest in your business, because what they do is they then support you, give you more commercial contracts, but they follow their money. And they've got deep pockets, these big primes. But not even the big primes, even smaller corporates have CVC divisions. So yeah, I agree with you, Richard. Family offices, which is, there's a million family offices, venture capital, incubators, CVC divisions, those are all really good sources of capital. Ultra high net worths, friends and family, people giving you 25 grand, make a minimum of 25 grand for your fundraise, for example, and you can easily get up to $1 million. So I think you really have to think outside the box until you can get that proper, venture investment.
Alternatively, come to us. We'll help you with that, because that's basically one of our specialties, to take little companies, smaller ones, and help them grow. I'll give you one example of a client which is not space related, but business is business after all. We got them in 2016. They do stem cells research based in San Diego. Today, over the years, we grew them to a stage where now they have got 4 facilities curing diabetes in India, 2 in the US, 3 in Mexico, 1 in Costa Rica, and 1 in Dubai soon. And these guys, we took them from inception, 2016, grew them to such a level that 1 year ago they were over 300 million worth and had a SPAC merger made for them. So that's basically what we do. We take you from very small, grow you up with time, because we work with time. It's not just a one hit, get out and move away. It's long-term duration. So that's us.
Yeah, that's a great point. I think what we're seeing more and more, actually, and this is unusual, because 10 years ago, private companies had a very hard time finding a third party to help them raise capital, because typically it was venture banks or just traditional M&A groups that would raise capital. But groups like Amal's and others now have begun to build a really good reputation of being able to get that CEO and get that team in front of the right venture groups, and provided you really understand how they operate, the fees are reasonable, because if they're not reasonable, the venture firms will not want to let you pay them. and that they've got a reputation for successfully closing financing, groups like this can be incredibly helpful because there's only so many hours in the day, and you can go through the European Venture Capital website and write down every company's name that's got funding to disperse, and it's really hard to reach out to those without contact. So that's something that really helps. I think what Jody was talking about on the corporate side is critical as well because they don't lead, but they are very, very liquid right now. And unlike the old days where a lead investor was always the largest investor in the round, that's no longer the case. Years ago, if you did a 10 million financing, the lead was expected to put in 5, 6, 7 of it. Now you're seeing a lead of 3 million, but what the lead is bringing to the table is significant expertise within the industry sector that you're in. A lead has to be somebody that can open doors, that can help attract talent, can hopefully help you enter new markets, and is going to do a majority of the due diligence and set the price. If they have the skills and capabilities to do that, they're going to make it very easy for you to attract other funding around it. So making sure that they have that expertise, they're willing to actually do that, the hard work, not just call themselves the lead. It's not relevant anymore whether they take up more than 50% of the round as it used to be. Can we talk a little bit about one thing that did happen last year, which was really interesting to see, was funding for startups using debt reached an all-time high, higher than any year prior, and that's not just in the US, but that is internationally. Venture debt has really taken off. Ironically, this is on the back of Silicon Valley Bank being sort of the inventor of venture debt, having their issues and ultimately closing a majority of their operations. Are you guys seeing venture debt being used in your companies? And,
Oh, yeah,
and
definitely.
how do you think companies should think about structuring venture debt?
Yeah, definitely. That's what we have seen, plenty of debt coming our way for those past 4 or 5 months. Mainly the biggest one being 450 million, 9% interest rate from Goldman Sachs, just to name them, being the lead, but only putting 25 million in the deal. All the rest they sourced out. So that's to confirm what Richard was saying earlier. And the problem of debt that we are finding out is that they are trying to get personal guarantees, even though if the promoter of the transaction, financially, if he had all the wherewithal to be able to do all of that by himself, he wouldn't be asking for a loan in the first place. So even with diminished, I would say, financial guarantees, still they are looking for it. Debt is happening more and more because I guess we are heading, that's my opinion though, don't quote me on that, but I think we'll be heading to a new subprime type of problem in some years' time because money is being not freely available but given to people in debt form, and it is being packaged on the back end of it. So that's what we are seeing for the past 5-6 months max.
We're definitely raising venture debt or looking to raise venture debt for all of our mandates. Silicon Valley Bank, which is now called HSBC Innovations, has a pretty good program actually. They've got several different products that they can offer to early stage space companies. So, but they are, as you say, they are secured debt. So you're going to have to secure it against your personal assets as a director. So that's not for everybody, to be honest. But it's their main product is quite interesting. So they don't start charging interest for a year. You don't have to. You can have I think an 18-month repayment holiday as well. But it not only is it secured by your personal home as a director, but it's also secured by your contracts. So they won't do any consideration for debt unless you have signed recurring revenue contracts. So it's difficult. They're one of the easiest, I think, from a venture debt perspective, though. But it is difficult. Yeah.
It is because at the end of the day, you're collateralizing something that with almost nothing when you think about it. If you were able, as I said earlier, to pay that type of money, to have that type of assets, you wouldn't be there in the first place. So it's all a little bit weird, to be very honest about it. I'll give you one example. A hotel being built with a big development, all in all it was $450 million. 50 million that the promoter put in, but it is in the form of land. And the land even was given by the government, so he didn't even put that. But still, they collateralize it because there is some land, there is something there, but then they're charging them 9.5%. I mean, that's horrendous. Imagine 9.5%, almost 10 with fees on $450 million. That's $45 million that you need to find at the end of the year. I mean, we're talking big money here. So these things are becoming a little bit silly because we are going to head to another type of problems very soon, as we have had in the past.
Yeah, I mean, I quite like convertibles, safes. Safes are very popular because those can convert at any given time, at any given price, and so debt is always paid back before equity is paid back if the business doesn't succeed, and convertible loan notes are the same thing. So they're really attractive. We're doing some our first investments for our fund at the minute, and all those are in the form of safes. And you can actually issue a safe equity round at a discount as well, where generally a Series C you can't really discount from a B. You get criticized from the venture capital community, don't you? So there's lots of ways to structure it. Again, as you said, Richard, I think everybody should, I mean, not us necessarily, but you should have an advisor that sort of maps out all their options before they go out to the market to raise money.
Absolutely. And bringing up convertible notes, convertible notes are becoming more common, and that's not venture debt, by the way. The venture debt numbers that we saw between 23 and 24, and now 24, exceeded everything before that. Convertible notes are not underneath venture debt. Venture debt is typically alongside a venture capital fundraising or a company that, as Jody pointed out, has significant revenues and royalties. But convertible notes are becoming very, very popular as a way of launching companies, and now SAFEs, SAFEs, are very similar in their structure. And very often it's a wonderful way to bridge a company between today and their next financing, provided that financing is within a relatively short period of time, where you can bring in X amount and offer those investors that are taking the risk a discount into the next financing. So, for example, they put in $1 million, you don't need to set a valuation on the company. So you're saying, we're not ready for our valuation to be set, we're going to let a professional investor do that next year, but we need $1 million to get there and achieve these milestones, and we're going to convert your $1 million into this next financing at a discount. So if the next financing is at $1 a share, those investors are able to convert their $1 million in at 80 cents a share. So that's a wonderful way of sort of structuring bridge financing. We often joke that there's a difference between a bridge and a pier, and a bridge needs to get somewhere. So you have to really be careful that the money you're raising on a bridge is actually going to get you to where you need to go, or there will be significant penalties by the holders of the note. So raise enough money that you can actually achieve milestones and raise venture capital. You don't want to be going back to those investors in 9 months saying, oops, we actually need another $500,000 to get there. Perhaps we could talk a little bit about the industry sectors getting the most funding. I mean, deep tech has obviously had a significant impact, and deep tech sort of being, not including AI, but deep tech being everything from quant to machine learning, et cetera. But deep tech in Europe has fallen far behind. Over the past 10 years, deep tech in Europe raised about $94 billion in venture capital. In the US, it was about $300 billion. China was right in the middle. China was about $125 billion in deep tech. What we're seeing now, though, is in AI. AI is a real challenge here in Europe, where you're seeing the US putting probably $4 for every single €1 into AI. And I'd be interested in hearing your thoughts as to, are you seeing AI deals, and how are they thinking about valuation? Because AI is playing a critical role in the space industry.
So, regarding AI, it's the new thing. We've got so many deals coming in, everybody has got an AI aspect to it. So now you have to differentiate between a real AI machine learning large language model and all the other companies just adding that word in there, doing something in order to try to attract money. Because money is hard to make, hard to obtain. Just be aware of that. That's really a problem for many, many companies out there. So now we have seen, I mean, if you go on our website, twex.exchange, you will see there, we have got like 10 AI deals. But then when you go deeper into it, yeah, it's AI because they have a bot doing something, and then that's about it. If not, the rest is business as usual. So that we have found that there is an issue on that one. And the big real AI companies, I don't see them, I mean, I haven't seen them coming to try to raise money. They are being gobbled up by big players. So that's what we are seeing.
Yeah, I mean, I think it's like tech. When I was a tech analyst in my 20s, and tech was actually a sector, and on my business card it said tech analyst, which is quite crazy. And yeah, and space, I think, is the same sort of thing. I think the space sector won't be a sector for much longer. Space is everywhere. And I think AI is the next to follow that. So I'm finding AI is everywhere. So we've got one investment that we're looking at in Europe at the minute. It's for the fund. And they do, so the fund focuses on impact on the planet Earth. So they do observation, focusing on providing their technology to energy companies. Anybody can download, as you know, Earth observation data. So that's free for everybody, and there's thousands of Earth observation companies taking that data and trying to sell it to people. But they all pretty much have the same thing, and there's nothing clever about it. But this company does have AI built into its technology, and it's super duper clever. So it's not an AI company, but without the AI built into its weather data technology, it wouldn't have a USP. It also has a unique data set, its own data set, which it then uses AI to integrate across all the other weather data sets, and then aggregates the information and sells it to huge blue chips. So I think most Earth observation companies in particular are going to have to think about integrating AI to make their product unique.
Absolutely. We're seeing, certainly in the Earth observation space, because of the amount of data actually being collected by the satellites, the quality of the imaging is absolutely phenomenal. But we're also seeing AI being implemented very aggressively in areas like situational awareness, which is becoming very important as we're seeing more and more satellites in the terms of thousands of satellites being launched. Earlier this week, you may have seen, it was, I think it was 4 rockets launched all the same day by different companies. First time that's ever happened. So as those rockets are going up there, dropping off satellites, you've got a lot of situational awareness, a lot of AI behind that. Debris management becomes a big piece of it. We're seeing a lot of AI being used in drone companies as the drones, whether it be on the defense sector or it even be on sort of Earth observation or even looking at topography. And we're looking at one company right now that's in the drone space specifically for wind power companies and being able to look at maintenance of wind power companies using drones. So AI is becoming important, and I think as long as Europe doesn't regulate the hell out of it, they'll actually catch up. But it's a big difference right now. If you look at last year, 45 billion invested in AI in the United States, 11 billion invested in Europe. So I think it's really important to incorporate that into your plan, and that becomes a very good selling point for investors. We should probably open up to questions if there is some from the crowd. Any questions, thoughts on fundraising or Europe as a whole? Yep. Yes, please.
Yeah, maybe one question. Space is quite a specific market with long delay to develop products and also to launch in the space. So I was wondering how from capital investors are seeing this market, because usually they tend to look for a 3 to 5 years return. And I was wondering if you play it a bit different in that market. There was a mention of a long-term investment, which is interesting. And also compared to AI lately, which is a quick return, why would you invest in space more than AI today, for instance?
I think a very good question. For those that didn't hear it, it was sort of the space industry as a whole obviously is very, very intensive when it comes to hard costs, and the time frames are much longer. Why invest in the space sector as opposed to digital startups? I think that thankfully there's investor pools for every sector, and this is no different than in the technology sector. Companies that are investing in a B2C solution that's going to be a downloadable app, their cost of goods is incredibly low, and they're able to get to proof of concept very easily, versus a company, let's say, that's building semiconductors. They're both tech companies, different metrics. I spent years investing in and also doing work in the healthcare sector. It's exactly the same thing as space, right? You can invest in digital health, you can invest in diagnostics, you can see a return, you can actually get to a proof of concept in 3 to 4 or 5 years. But if you want to do drug discovery, you're talking a dozen years by the time you get out of clinical trials and get a product to market. So the space sector, as Jody pointed out, is becoming ubiquitous. I will say that investors are typically a traditional venture fund, right, is a 10-year fund for whatever reason, whoever picked that. And there's usually a 3 or 4 year, maybe 5 year investment period. So you're looking to deploy your fund over that period of time and then harvest over the remainder. So 4 years of deploy and 6 years of harvest. That doesn't equate very well if you're looking to build a colony on Mars, right, or any other large expenditure. And that's where I think you'll see the corporate financing comes in, and significant government financing, because their timelines are entirely different, right? Going to a traditional venture capitalist to build a SpaceX, it's not logical in many ways, right? You have to think about government funding. I mean, Elon Musk did a phenomenal job raising hundreds and hundreds of millions from the US government, right? So I think that that's something to think about. Is your value proposition going to be able to actually show proof of concept, hopefully be profitable, but even if it's not profitable, is something you're building going to be easily acquired by a bigger company in less than a half a dozen years? If the answer is no, we're still going to be in R&D at that stage, venture capital is not going to touch it.
Yeah, no, I agree, Richard. I think that the problem with the space sector is a lot of the companies in the sector are kind of laden with very brilliant technologists, but they come to someone like us and say, "Can you help raise 20 million?" But so I say, "Okay, who's your finance director?" "Oh no, I don't have a finance director." And have you ever run a sales team? Nope, never run a sales team before. I'm thinking, well, so those are the companies, as you say, that are suitable to be acquired by bigger businesses for sure. And we are working with primes at the minute, 2 primes at the minute, acquiring specific sorts of businesses. So we're also working with a U.S. aerospace business that has hired us to acquire UK and European composite businesses, aerospace businesses that they can distribute through their DoD channel in America, which is quite interesting. So, and it's worth picking up the phone, again, I said it before, but to the primes and seeing if that you can start building a relationship with them so that when you are at the point where you could be acquired, that possibly you would be someone that they would consider. But you never know what big companies are looking to acquire at any given time. They changes about every quarter sort of thing. So, you just got to do the heavy lifting and pick up the phone and make the phone calls and build the relationships with the companies that you think your business might be suitable for. The likelihood that, a startup is going to grow its business and it's going to be a unicorn is obviously very small, but you can make a huge success by being part of a bigger company. But also, as I said, there are IPOs happening now in the space sector. So Voyager Technologies is going to IPO in America, which is fantastic. So that's a great exit. Astroscale in Japan IPO'd last year, and that provided a secondary market for lots of investors that have been in Astroscale for many, many moons. So IPOs are always a great way to exit for any investor, venture capital or private investors. And I think on the M&A side of things, I think within the next 2 months, we're going to hear some pretty big M&A announcements in the space sector. So you might know that there's a couple really, really big ones on the table at the minute, and lots of smaller ones. I think that companies are, from my perspective, a lot of space companies are panicking a little bit because this is the opportunity. It's the J curve, and they're just running around going, "Oh God, I really want to capitalize on this opportunity to grow my business." So whereas they wouldn't have acquired, last year, this year they are looking to. I've got one company looking to acquire geospatial awareness businesses. So it's super interesting on the M&A side.
Absolutely right.
I think we have time for one more question.
No, it's fine. It's not working.
Two more.
Good morning. My name is Peter Bishop. I'm the managing director of Bishop GmbH. More than 30 years in Germany, and 30 years ago I founded my company. Let me start by thanking Maxine for organizing Paris Space Week. I've been coming for over 10 years, and it's a great show where you can meet people like yourself on the stage, looking for small companies. So, keep coming, and, perhaps you'll be successful. As you can hear from my accent, I'm from the UK. I'm, back in the UK. I still run a company in Germany. What concerns me is that since July, we have a new government in the UK, and they seem to be taxing small businesses, small farmers, and I think, well, what about me? What's going to happen to me? I may have to put up my personal property as security. I'm working very hard and all that. Then I think back, well, I've been in America. I've been knocking on doors, Northrop Grumman and Seattle, and the big waves of changes there, when a lot of middle management was sort of, Monday morning made redundant, and then my contacts were lost. All the hard work I'd done was lost, and I have to start again. But assuming in 2025 I'm successful and make good progress, should I base myself outside the EU in UK? Should it be America? Should it be Germany or Sweden? What should I do? And what can I do to mitigate handing big chunks of any profit I make or money I get when I sell my company? What can I do to mitigate paying so much tax that it's not really worth making the effort? That's my question.
So I guess if you're going to talk about taxes, that's a different forum. Have to do it one-on-one is better for what you have in mind. But the UK, I don't know if that's really the place for that type of business there. You're looking to develop, to grow much faster. Go to the US, you'll be better served there, you'll have much more access to capital. But at the end of the day, what really matters is the quality of your business. What we are looking at, do you have any type of revenues? Do you have a value proposition that makes sense? Okay, sure, it is in space, but still, money is money, finance is finance, and profits are profits. So we have to be able to, I'll give you one example. When we started in the space arena, our biggest problem was to value these companies. Our valuation department was struggling big time because you say, usually you take market comparables. Yeah, but those are new businesses. What market comparables are you going to take to value them? So this, I remember when we started focusing on space, was one of the biggest problems. But at the end of the day, it's a business as any other one. Either you have something that makes sense, people want it, or you just have to put it away. So that's basically my take on that one.
And I think we have one question behind you.
One more question.
Yeah.
So it's just a very quick one, and I have a vested interest in this because I work for an insurance company, but we haven't talked about insurance capital as another form of regulated contingent capital. And from our perspective, particularly in this sort of startup culture, it's really a play for two reasons. Firstly, it's a confidence play so that your businesses, your investments are backed not only by your house, your car, your personal guarantees, but also by regulated insurance capital. confidence for investors, confidence for your customers or potential customers. And it's also a resilience play. So if there are critical aspects, for example, in your supply chain, which will mean you have a supply chain failure, you have a missed launch, you haven't met your milestones, your bridge financing, as you were saying, is about to go pop. That sort of resilience, whether it's sort of pre-launch, part supply, in orbit, launch, or anything thereafter, cyber attacks are a huge risk. That sort of resilience play is, I think, an area in which insurance capital can and does play an important role in the space industry.
Yeah, there's two sides to the insurance industry in space, isn't there? There's the being able to get your rocket insured, which you can't do until you've had one successful orbital launch. So that's pretty a sad case. But it's improving. More and more insurance companies are able to write policies for particular payloads. And the other aspect of the insurance industry in space is really important, which is allowing insurance companies to better observe the Earth and to insure things more accurately and efficiently and cost effectively. So, and that's going really fast. And I've got a bunch of deals that have been done over the past month just here. And I think there's 5 insurance companies that have been funded over in January in the UK and Europe. And the US. So yeah, it's a really growing industry, and God, it couldn't come too soon in this sector. We've been dying for it.
I think we are out of time. This has been great. Thank you guys for your wonderful questions.